I'm going to talk about three things today. First, the nature of systemic risk. What's the nature of this beast that hit us about 5 years ago? Second, what can be done to cure it? And third, what are the implications for derivatives? But first, people like to talk about systemic risk. It comes up at cocktail parties, but not a lot of people really know what it means. So what the heck is systemic risk? There are a lot of loose definitions, but I think these are reasonably decent ones. The first one emphasizes, it's actually from Wikipedia, so I think nowadays that means it must be true. It highlights the core theme, which is it's not about the risk to an individual firm or institution, it's about the risk to an entire market or financial system. It's not a single accident, it's a broad process. The other two quotes highlight a couple of things that often come up in this discussion as well. The second quote talks about it's got to have a big impact on the real economy. If it's just a problem within the financial sector, that's not enough. It must have something that really affects what happens to GDP. And the third quote highlights another set of facts that are often associated with this, that it's often a very distinct change of phase. You feel like you've gone from one world to a completely separate world. And you find out in that new world that there appear to be vicious feedback loops that are very hard to get out of. So if I was going to summarize it, systemic risk is not the thing on the left, it's the thing on the right. It's not about a single car accident when it's your fault you drove into the tree. You can't really blame the tree. But even if you're a good driver and you're somewhere in the middle of that highway, it's going to be very hard. Whether you're a good driver or a bad driver, you're caught up in a mess. And that's the nature of systemic risk. The whole highway is having a problem. Now, you don't see that sort of situation on the right, thankfully, very often, and you don't see systemic risk in the financial markets very often. How much does it really happen? Now, I've seen it blamed a number of times, but how much does it really happen? Let's look at some history. Now, this is a little hard to see in a room this big, but just to give you a sense of it, this is an 80-year graph of some U.S. financial data, and sorry, it's a little U.S.-centric. And these are the best proxies I could find for systemic risk. The top chart is equity volatility. How jumpy are stocks? When vol hits 80, 90%, as it did in the Depression and in 2008, the market is systemic. It's not differentiating stocks by name. In some of those days, the entire S&P 500 went up with no exceptions, and in other days it fell. The market's dominated by giant risk-on, risk-off trades, not individual firm behavior. You do see a little spike in '87 from Black Monday, but that lasted only a few days. The bottom chart shows investment-grade credit spreads, the lowest rung of investment grade. And there are also two periods that stand out. When investment-grade credit was trading at over 500 over. And as swaps people who are active in CDS, you can think of that as a 25-point cumulative 5-year risk premium. And that's sort of like a 50% chance of failure with a 50% loss. That doesn't feel like investment grade. That feels like a dysfunctional credit market. So I'd say from the credit market's perspective, we also have two episodes that strike me as clearly systemic. There are also one other thing that's not graphed here, but I think is important to note in both of those periods. They were accompanied by huge amounts of stress in the financial market. In the Great Depression, we lost a third of the US banking system in just 2 years. It's an amazing statistic. 4,000 banks went out of business in 1933 alone. So it felt a lot like that highway scene on the right. And you all know what was going on to the financial markets and the stress on Wall Street and in major banks in Europe when you go back to 2008. Again, very distinct phases, I think, compared to the intervening 75 years. Let's drill into 2008 a little bit more. What did we learn from all this? I was a chief risk officer of Credit Suisse at the time, probably not the wisest time to take that job, but at least an interesting time. And I'd like to break it down into 3 phases with the benefit of some hindsight. The first time I felt real fear was in August of '07. And I was on the fixed income floor, and people were yelling, T-bills are on fire. And that is not something you want to hear. I like markets to go up, but not that one. Because it usually is a flight to quality. It's usually evidence of real panic. And you can see that here just above that yellow arrow when that first hit. Now, mortgages had been in the frame for probably 6 months. A lot of stories written about the subprime crisis. But this is the first time it started to feel like fear. And what was it that changed the market? It's a somewhat strange chain of events, but the thing that strikes me as the most plausible proximate cause is that BNP suspended the NAV on a couple of their mortgage funds. And you'd say, well, why should that be the cause of such a degree of panic? And with hindsight, I think, to me, part of the issue there was we had grown so used to thinking about mortgages as liquid, safe, eminently tradable and priceable collateral. We thought of them basically like money. They were always there when you needed to. But when you can't actually even get a price for these mortgages, and when you can't pull your money out of a mutual fund, that's not money anymore. That's a risk asset. And so the world lost a big chunk of its money supply given how huge the US mortgage market is. And banks lost an important source of liquidity and started going much more into panic at that time. The market went on for a while, and you can see here in phase one, starting with that BNP event at the left part of the yellow circle, we saw elevated equity volatility for a little over a year. But that totally changed when Lehman failed. And you can see the systemic risk graph. We drilled into that graph from the previous page. The risk line basically goes vertical. We've gone from what I would call sort of a pre-systemic fever into a full-blown systemic event. Up until that point, the equity market had held up okay. If you went away from the fixed income floor, which was all gloom and doom, to the equity people, they still thought it was business as usual. And the real economy was holding up okay. When Lehman happened, all that changed. The point here is to show how dramatic the break was between an asset class crisis and a true systemic crisis. It was a phase shift to a new destructive equilibrium where the financial system was really at risk. Now, interesting, Europe did not have the same kind of vertical line around that period that the US did. Europe delayed a lot of this, and so I'm going to call this phase 3, but I really think of it in a sense as a delayed phase 2. Europe tended to guarantee a lot of the big players in its banking system, and that squelched the fire for a while. But some countries were not able to handle that, handle the pressure. Think about Ireland, that guaranteed all the deposits in their banking system, but then the country ended up going bankrupt because of the ultimate strains. So it exposed strains both among the EU member states and between banks and the states. So I tend to think of this as Europe was able to delay the systemic phase of this crisis, but they didn't end up paying the piper and are still paying the piper today, trying to work through their phase of the doom loop. You can see here in particular, one of the other elements of systemic risk, particularly in Europe, is the integration of sovereign spreads, which are the yellow line, and senior bank spreads. The bank spreads were coming down as the US market started to heal in early '09, but as sovereign stuff started to move up in 2010 and 2011, that took the rest of the market with it. Some observations on all this. The first real test of the market's resilience was when we let Lehman fail, when the government decided that they would no longer step in and protect the bank. It wasn't that a US trading house could fail. Bear had already tested that. The difference was that the US revealed a willingness to let a big bank fail and take the consequences. And unfortunately, the plan B was not particularly impressive. Policymakers were aware this was a gamble, that this was a big deal. In testimony, Ben Bernanke said, I thought this was going to be an 8 out of 10 on the Richter scale, a really huge event. It turned out to be an 11. To me, there are a couple of causes that drive some of this, that are deep causes of this. The first one is there was extraordinary loss severity at Lehman Brothers. And what does that mean? Lehman itself was not a complete basket case. It still had M&A prospects. It had some bad assets. It was talking about this spinco where it hold bad subprime and commercial properties and some private equity business. But the basic business was actually still making money. So it wasn't a basket case, but it did have an asset problem. I was at the Fed the weekend that they tried to figure out a rescue. And when we sent experts out, we thought the assets were maybe 25 billion plus or minus 10 billion overvalued. So a big problem, but not an overwhelming problem in the overall scheme of things. That would wipe out the equity of Lehman, so it would be a big problem for that organization. But it shouldn't impair the rest of their liabilities to a huge extent. Well, in fact, it did. The market didn't just wipe out the equity, it wiped out the subdebts, the preferred, and 91% of the senior debt if you go by the CDS clearing level on the next week. That wiped out an extra $125 billion of value in the market. It took a $25 billion problem and turned it into a $150 billion loss for the market. That's huge. The other issue was there didn't seem to be a plan. Everything looked ad hoc, and that was because everything was ad hoc. There was a new idea, it seemed, every day. You would merge Citibank with Morgan Stanley. No, we'll merge some other banks. Maybe we'll buy their bad assets with the initial idea of TARP. Maybe we'll recapitalize them. We had all kinds of new ideas, but we did not have a systemic answer until ultimately we forced recapitalization and forced a stress test on all the big US banks. Whether you like that or not, at least it was a systemic answer, and it did turn the tide. I'd like to spend a moment just on this loss multiplier issue, this issue that we saw at Lehman of taking a $25 billion asset problem and scaling it up to a much bigger problem. Let's take a little bit of a cartoon model of a financial system. Let's assume that one, we know the government will let a big bank fail, and two, that when it fails, it has a loss multiplier involved. This cartoon traces it out. We have external asset losses of about 25 billion that push over Bank A, which creates 150 billion of losses for the system. It doesn't absorb losses, it amplifies them. Those losses have to go somewhere, and they're going to put stress on investors and counterparties, some of whom then may well fail. If we read through the consequences of that, if some of those fail, they're going to be adding more and more of this type of extra loss into the system. And you can get a very quick and explosive financial reaction pretty quickly. I think some of this was behind the cascading losses that we saw in the 1930s, and was also at the heart of the cardiac arrest that was hitting the market in 2008. It's an inherently fragile system, not a robust one, when firms can't absorb losses when they actually spread them. We need to have a system that absorbs losses effectively, something that can help us build a system that has much more resilient pieces to it. So what might that look like? What can be done to address that type of issue? How can we stop a local fire from becoming something you see on the TV news? So let's say you're the fireman in this picture. What's the smartest way to solve your problem? How would you do it? Well, luckily we've gotten a lot of advice on that. We've got Volckers, Vicker, Likkonen, Moscovici, narrow banking subsidiarization, size curves, gross leverage, dogs with frisbees. I won't go on, but there's a lot of ideas out there. It seems like we're pretty much emptying the medicine cabinet of this problem without really understanding the diagnosis. And to me, if you spend time on diagnosis, it's really about stopping that transition from the phase 1 to phase 2. It's solving the too big to fail problem and really nailing that. And there are some people here that have actually much fancier resumes than me that also see this as the core. That if we can solve this part of the puzzle, we really change the game. resolution and bail-in, solving too big to fail, is at the heart of a real solution. You've got to target that phase shift and keep the fire from turning into a wildfire. Now, don't get me wrong, living in phase one, the mortgage crisis, was no picnic, but it was a heck of a lot better than phase two, when our markets were on the front page in very big letters of all the major newspapers. We've got to stop that systemic phase, and we need a much better fire break against that going forward. So how do you do this? People talk about bail-in and resolution techniques. I'd like to give one example here. Let's take a balance sheet that's about $600 billion of assets and funded with liabilities you see just beneath it on the left side. And let's say you find out your assets are not worth what you might have hoped they were worth, and in fact you've got to take a $25 billion hit to 575. That doesn't seem like that big a deal in asset terms, but it is a little awkward if you have double entry bookkeeping and you write down your equity to zero. So if you've got a recapitalization mindset, if we were thinking about this in a corporate mindset, we would be writing off the equity, and then we'd be converting the liabilities above that into equity until we had a stable new capital structure. So in this case, we'd be converting preferreds and sub-debt, and maybe a slice of the senior debt into new equity. In this case, we've actually created $43 billion of new equity, so we've actually increased the equity beyond the starting $25 billion. We've got almost double that amount of new equity, and we've got a hard asset balance sheet. So we've recapitalized it credibly. Importantly, we haven't touched this middle part of what we call franchise liability, which is what I think about as the factory of banking. Most industries don't have a large part of their factory on the liability side. They tend to own mines or factories. But banks do a ton of their business on the liability side. Whether it's deposits or swaps or whatever, a lot of things show up on the liability side. And if you write down the pieces of the factory, I think you impair the value of the factory and make it much more difficult to recapitalize. So if we could have done this, instead of having the kind of hard failures that we had in the 2008 crisis, I think we would have been a lot better off. In fact, these are the numbers for Lehman Brothers. The numbers on the left are from their third quarter report. And I think if we had had bail-in powers back then, we could have engineered something like the right-hand side over that weekend. We would have needed a lot more legal powers and a lot more preparation, but we would have had a much better outcome on Monday than the one we actually had. And I don't think the system would have started going into cardiac arrest. The most frequent objection I hear about this proposal tends to be from bond investors. They say, well, wait a minute, you're protecting all those franchise guys, the swap dealers, the depositors, the settlement systems. Why am I taking all the pain? And I think the best answer for them is think about your alternative. In the Lehman case, your senior debt went down to 9 cents in the dollar the next week. In this case, you've still got 85% of your claim, and you've got equity as well. I think that package probably trades between 80 and 90 over the course of the next week. And if you own equity and you get a little bit of the rebound that we saw in 2009, you might be back to par. That's a heck of a lot better proposition. The important thing about this is it absorbs losses effectively, it protects systemic functions, it avoids using taxpayer dollars. It's a real private sector solution to a private sector problem. It's got important implications. I think it lowers contagion because you protected runnable clients like retail. You don't have impact on the swap markets, which can be a source of contagion, or other key market infrastructure like other clearing systems. You reduce losses for long-term bond investors. Instead of an M&A solution or a liquidation solution, you're creating new equity at the point of failure, which is exactly what the market needed but didn't get. And lastly, it doesn't impair sovereign credit, so a lot of the doom loop issues that we see in Europe would not be in play. I think this system has much better properties. It's replicable. It should enable us to reduce losses. Now, this is not just an idea. This has actually been turned into law in several places. In the United States, it's basically been FDIC policy for almost a year now. They figured out how to use Dodd-Frank language and this concept, and it basically said, this is our policy for major banks today. And despite all the front page stuff you read in the papers, I think the US actually has a credible and workable too big to fail system today. Europe, I think we're a few months away from something. They're still working out the Recovery and Resolution Directive, but I think we'll have that in place this year, and that will include a strong bail-in program. So the two biggest financial blocks in the world, I think, are moving strongly in this direction. We're on a good path here, and I think this will help us solve too big to fail, which is a huge change from what we had in 2008. What's this mean for swaps? We've had a lot of talk over the last day or so about the regulatory tornado that's coming through our markets and other markets. Now, swaps have been accused of a lot of things in the crisis. They've been accused of causing the crisis, spreading it, premature hair loss, pretty much everything that you could accuse swaps of, they've been accused of. There are some important facts that people seem to miss. One, no banks actually tipped over because of swaps. I know at my bank, swaps actually helped us hedge a lot of our risk and helped us get through the crisis without government money, so they were actually very helpful to us as a true risk management tool. There was the AIG case, and that's a very important case, and one we have to address, and where I think a lot of the reforms are targeting that type of situation and targeting reasonably well. But I want to talk about a different element here, which is the unwind procedures. That was actually a huge concern at the Fed over Lehman weekend. They were really tense about that. And in fact, I don't know if you remember, but they even tried to engineer a sort of quasi-Sunday trading session of swaps so everybody could unwind them before Monday morning, if and only if Lehman declared bankruptcy by midnight. It didn't really work, but it showed how nervous the Fed was about that. In the end, actually, the ISDA unwind procedures worked pretty well. It wasn't pretty, but we got through it, and the system worked. So you might say, that part of things, whew, that worked. The only challenge is it was hugely expensive. Alvarez and Marshall, who are the receivers of the estate, calculated they cost the estate, the unwind process, over $40 billion. That's more than all the ex-ante mistakes that Lehman made in real estate and private equity. It's an obscure issue, but the size of it makes it a really important issue. Importantly, it is a loss multiplier, like that stuff we talked about before. This was one of the big factors that turned that $25 billion loss into the $150 billion loss. And so it's something that as we're building a safer system, a more resilient system, we need to fix. It's important for a credible too big to fail regime, and it's important for a stable system. So how do we do that? What's the nature of this problem? In the words of the great George Costanza, it's not you, it's me. Most of us were brought up in swaps to fight like heck for our creditor rights. We're all trained to protect our firms against the risk of the other guy. The main concern is the risk of the counterparty, i.e. it's about you. But in the new world, we need to think more broadly. We also have to contemplate our own demise, however uncomfortable that may be. That's what an RRP is all about. And if in an RRP we need to show that we can fail safely and effectively and efficiently, having a large unwind cost is simply not acceptable. It's not a graceful way to exit the market. There's a couple ways you could go at this problem. Dodd-Frank and some of the European regimes will put a stay on swaps in the local jurisdiction. So that's one partial solution. For example, if a US firm hits the wall and they turn on OLA, and if your contract is moved to the bridge, and if your contract is US domiciled, if all those three things hold true, then your swap won't unwind. But if any one of those three things don't hold true, the unwind rights persist and you still have this problem. So we could hope for better, smarter legislation. Maybe there'll be a global resolution law someday, probably not our lifetime. But I think there are some things that we can do. I think we can drive this forward in the private sector through a contractual solution. Not tomorrow, this will take time to do, but I think we can make a huge dent in this problem. I think we can come up with a private solution, a private risk solution, which is, after all, one of the things is fundamentally about. This would help the official sector in their efforts. It would require us to move to a balanced treatment of the creditor rights that we were all brought up with, to a more balanced view of that, plus the resolution objectives. That may feel unnatural for some of us who are brought up in the old way, but it's essential that we get there. This is controversial with some people. Some would say, why should I give up my rights, my unwind rights, for some public policy goal? My duty is to my investors. That is a legitimate question, but I'd say even if you're a hard-nosed cynic, my view is that fighting this is a losing battle. The policy people want to get to a more stable system. They understand the importance of this issue, the importance of too big to fail, and I don't think this is something that you can credibly fight or sensibly fight. It's much smarter to work with them and get this done right. Many of us also want to find a solution. ISDA has long championed the importance of safe and efficient markets, and our role in the world is to help people hedge risks. So this is a chance for us to help our markets build a hedge against systemic risk, because we all benefit from a safer, less systemic market. I've talked today about three things and covered a lot of ground. The first, the nature of systemic risk. In the last 5 years, we've all had to learn a lot of hard lessons about what that looks like. As Mervyn King, it's not just something for the history books with guys in top hats and carriages. This is something that we had to live through in our lifetimes. But at least we can put that to use. I doubt we can eliminate all the phase one type risks, all the asset bubbles in the market, but we can end the phase two section of the crisis, the systemic phase. We can solve too big to fail, and we must end too big to fail. That's important for our markets, for our relationship with taxpayers, and our position in the system won't be secure until we've done it. And third, swaps must do their bit. We've grown up a lot in 28 years, and swaps aren't a kid anymore. They're a huge market and systemically important. So we must do our part so that everything is not systemic again going forward. Thank you.